Welcome back to the deep dive. Today, we're strapping in for a high-velocity look at a set of earnings results that just completely defied expectation.
They really did.
We're deep diving into the Q3 fiscal year 2026 report for Infosys Limited, which dropped pre-market on January 14th.
And when we say defied expectation, I mean the stock vaulted over 10% on the news, on massive volume. So our mission here is to unpack why. Why did the market get so enthusiastic?
Right, because it wasn't just about the headline numbers. It was about prioritizing the forward-looking story, the guidance, the monumental deal wins over what, initially looked like a pretty mixed bag.
Exactly. This wasn't just another quarterly call. It felt like a real narrative shift, a potential turning point, really, for enterprise AI spending.
Okay, so let's start with those headlines because they were a little confusing at first glance.
For sure. So on the revenue side, things look decent. They reported $5,099 million.
Which was a modest beat, right? The street was looking for about $5.08 billion.
A modest beat, yes. But the important part was the sequential growth. 0.6% in constant currency.
And that's key. You have to look at CC, constant currency, to strip out all that foreign exchange noise and see the real demand picture.
It was moving in the right direction, but then you get to the earnings, the EPS, and this is where the noise started.
Yeah, the reported GAAP EPS was 19 cents. Consensus was 20 cents. So on paper, that looks like a miss.
A small miss.
Yeah.
And if you just stopped reading right there, you'd be scratching your head thinking, wait, why did the stock rally 10%?
And that's the whole game, isn't it? You have to look for the adjustment.
You have to. And management was very clear. The entire miss was due to one single thing, a one-time charge from changes in India's labor codes.
So a technical accounting hit, not an operational failure.
Not at all. And the size of that charge was substantial, 1,289 crore rupees. I mean, to put that in perspective, that charge alone wiped out over 12% of their reported quarterly profit. It was a massive non-recurring lump.
So if you adjust for that...
If you adjust for that, their basic EPS was 20 cents, right on the money. The market saw it, knew it was a formality, and just moved on.
Okay. So if revenue was just okay, and EPS is a technical beat, what actually lit the fire under the stock?
The deal momentum. This is where it gets really interesting.
The TCV number.
The total contract value. $4.8 billion.
Yeah.
And what's fascinating is the mix. A really robust 57% of that was net new business.
So not just renewals, they're actually winning new clients, new logos.
They're taking share. And for a company their size, locking in nearly $5 billion in a single quarter is it's a monumental feat.
And how does that stack up historically? I mean, is this an outlier or a trend?
It's a huge trend.
Yeah.
The TCV for the first 9 months of this fiscal year is now $11.7 billion. That already exceeds the total TCV for the entire last fiscal year. So they're pulling in future revenue at a pace we've just never seen from them before. That's the signal.
That is the structural signal that overrides the short-term accounting noise. Okay. Let's talk profitability then. That charge must have hit the margins.
It did. The reported operating margin was down at 18.4%.
But again, you adjust for it.
Adjust for it, and the margin jumps right back up to 21.2%.
Yeah.
Puts them right in the middle of their target range.
Which is 20 to 22%, so they're holding the line.
They are. And look, beneath all that, the free cash flow was exceptionally healthy. $915 million reported, $965 adjusted.
And the conversion rate?
A stellar 113% of adjusted net profit. So they're generating way more cash than their accounting profit suggests. Just an efficient cash machine.
Okay, so back to the deals for a second. That $4.8 billion, it wasn't a bunch of small projects.
No, not at all. It was 26 large deals, and they specifically called out 2 of them as mega deals.
And the one everyone was focused on was the UK National Health Service deal, the NHS, $1.6 billion.
A massive win. And you might ask, is this just them taking business from a competitor, or is it true market expansion?
That's the key question.
And management answered it. The deal is specifically focused on leveraging AI, their Topaz platform, to streamline operations. This is not a classic lift and shift outsourcing deal. It's a digital transformation deal.
So the market sees that as a higher quality win, a true share gain based on technology, not just cost.
Exactly. And the wins are really well diversified. 10 in financial services, 4 in retail.
3 in life sciences and manufacturing. The sales machine is clearly firing on all cylinders.
Which brings us right to the core of the whole story. AI-led share gains. It's all centered on Infosys Topaz.
Right. They're basically making the case that they're winning because of their AI expertise.
And the numbers they shared are, frankly, pretty impressive. They're working on 4,600 AI projects right now.
And what about with their biggest clients?
They're engaged with 90% of their top 200 clients on AI initiatives. This is not just some experiment on the side. This is deep market penetration.
So when they talk about AI, where exactly are they making money? It can feel like a buzzword sometimes.
Well, they were very specific. They laid out 6 emerging AI value pools where they see big opportunity.
Okay, let's run through them.
First is AI engineering services, so building custom models. Second, data for AI, basically getting a client's messy data ready for AI to consume.
That's a huge one.
Yeah.
Then agents for operations, which is building those specialized AI agents to handle business processes.
Right. And fourth is AI software development and legacy modernization, using generative AI to, get rid of those ancient IT systems faster.
And the last two.
AI and physical devices, think smart factories, IoT, and then just the broad category of services, which is the big consulting and integration work to tie it all together.
It's a full stack approach. They're attacking the entire value chain.
And this push toward agentification is really interesting. They highlighted a product called Topaz Fabric.
Which is like an operating system for enterprise AI.
That's a great way to put it. It helps clients manage and deploy hundreds of these different agents without creating total chaos. They're also partnering, like with Cognition, to bring in specialized agents like their Devon software agent.
So they're building and buying best-in-class tech. Okay, so where is this actually translating into revenue right now? Which sectors are strong?
2 clear pockets of strength. Financial services, where discretionary spending is finally coming back, and then energy, utilities, resources, and services, or URNS.
And they were pretty bullish on those two going forward, weren't they?
Very bullish. They explicitly said they expect growth to accelerate in FS and URNS next fiscal year, FY27. And the reason is they now have AI partner status with 15 of their top 25 clients in each of those verticals.
That's a concrete forward indicator. The market loves that. But we have to look at the other side. Where are the weak spots?
Yeah, the recovery is definitely not even. Manufacturing is still really challenged. Geopolitical risk, slow decisions, the auto sector is struggling.
So clients there are just not opening their wallets for big projects.
Not yet. And you see a similar story in retail and CPG. It's all about cost takeout, not big transformation. High tech also remains under a lot of pressure.
So that bifurcation is crucial context.
Yeah.
Okay, let's get to the most important signal of all, the guidance.
This is what really sealed the deal for the market. They raised their full-year revenue guidance.
They revised it upward to 3.5% constant currency growth. In this environment, any raise is a huge signal.
It is. And here's a little detail for you. That guidance raise excludes any potential revenue from their Telstra joint venture.
Ah, so there's unbaked-in upside if that deal closes.
Exactly. Now, on the margin side, they didn't raise. They strategically reiterated their 20 to 22% range.
Which signals confidence that they can handle that labor code cost.
Right. They clarified the recurring impact is only going to be about 15 basis points. It's totally manageable within that range.
But they did warn about Q4, right? The usual seasonality.
Yep, the usual headwind from fewer working days and furloughs. So the real acceleration story is for FY27.
So how did the analysts take all this? Was it a consensus view?
It was a pretty clear split, actually. You had firms like Jefferies, who were very bullish, calling out the improving demand signals. They trust that the big deals will convert to revenue.
But not everyone was convinced.
No. Bank of America was much more skeptical. They argued, look, this guidance upgrade might not be sustainable if the weakness in manufacturing and retail continues.
Their point is you can't run on just two strong verticals forever.
A fair point. But the market cast its vote. The stock closed up over 10% on just massive volume. Investors are betting on the long-term AI story.
The structural shift is outweighing the cyclical weakness.
That's the bet.
All right, let's shift gears. It's time for the part of our deep dive that comes with the heaviest possible disclaimer.
This is not financial advice.
We're going to pitch an outrageous but plausible trade idea based strictly on the data we've just discussed. Please remember, this is for educational purposes only. It is high risk.
So the core thesis here is pretty straightforward. Infosys has successfully changed its story to be an AI-led share gainer. We see the proof in the deal wins, the focus on those 6 value pools. They are winning where it counts.
In those future-facing verticals like financial services. So what's the trade?
The trade is to go long INFY to capture that continued momentum and the acceleration they're guiding to in FY27. And you fund that long position by going short, a direct peer.
Okay.
A peer that is heavily exposed to the underperforming manufacturing or retail verticals. Somewhere the spending is still under intense pressure.
So you're playing the divergence. You're betting that this AI-driven spending is causing a flight to quality, which helps leaders like Infosys but actually hurts the laggards.
Exactly. It's a relative value trade based on strategic positioning in the market. The catalyst would be, one, any news on that Telstra JV closing. That's pure upside.
And the other?
The other is just seeing the proof in the numbers next quarter. If that $4.8 billion in TCV starts converting cleanly into revenue, this stock has another leg up.
That is a very high conviction trade. Again, purely an analytical exercise, not a recommendation. So to quickly recap our deep dive, a modest revenue beat, but that was really just noise. The real story was a powerfully positive forward narrative.
Anchored by that raised guidance and the record, $4.8 billion in deals. It's a clear shift toward AI as the driver, not just basic cost cutting.
All right, so the provocative thought we want to leave you with is this. Management basically said that AI is leading to both big consolidation wins for them, but also productivity benefits that compress legacy work.
Which means Infosys is selling deflationary technology.
And that's the core question for the entire IT services industry, isn't it? Can you maintain your pricing power?
Which management says they are.
While you're delivering technology that, by its very nature, automates and reduces the need for the historical work you used to get paid for.
The entire credibility of this sector for the next decade rests on that question. Can they keep growing revenue per employee, even as the bots take over? That is the metric to watch. It's a huge tightrope walk.
Thank you for joining us for this analysis. As always, please conduct your own due diligence and never make an investment decision based solely on what you hear here. Until next time, keep those deep dives going.